Polestar stock has been the topic of many conversations as of late, and also a trending stock to be traded at in the exchanges. In today's video, we're going to look at its price actions, the recent developments, the technicals, and my opinion on if you should be buying the stock. As the market is still very volatile at the moment, we should always be careful about which positions we pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to comment, like, and subscribe to my channel. Polestar has gathered a lot of hope and even some hype from the market over the past few months. For those who have lived through the merger between CCIV and Lucid Motors, you might remember how potentially rewarding when an investment is made on a stock at the right time. As a potentially new player in the high-end segment of the EV sector, Polestar has demonstrated to the market that it is a serious company and that it's going to roll out new models in the short term. From a price action perspective, Polestar has actually been very stable when the stock was still trading as a SPAC, and that it is for a good reason. SPAC shares can be redeemed back for up to a certain amount, and that price level forms a price level for the stock for a considerable amount of time. Now that Polestar has changed its symbol from GGPI to PSNY, I think that the next couple of weeks are going to be testing for the EV manufacturer. Depending on how challenging the stock market might be for the next couple of months and even years, Polestar would be expected to do no worse than the rest of the sector, and with an arguably higher rebound capacity, given the company's commitment to deliver those products. Now, let's also take a look at the technicals of Polestar. The trading volume of Polestar has recently been around 2.4 million shares versus the average volume of 3.8 million shares. Over the previous 52-week period, the price fluctuated between $8.64 and $11.36. The trading volume is a metric telling you how many shares are being exchanging hands and whether there's a lot of activities and momentum on the stock. It often gives you a first idea about the popularity of a stock. And we can also use it to compare with the average volume. It can also tell us if the company is enjoying additional momentum to reverse the trend or to break through current resistance levels. Even when the current volume is lower than the average, it is an interesting indication because it could signify a potential trend reversal. The market cap of Polestar is currently around $3 billion, compared to the enterprise value of $1.1 billion. To put simply, the market cap is the fair market value the company has based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost the company has already paid for the assets after paying off the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies are the intangibles, meaning they're not items or stocks that the companies could use to generate income immediately, but promises of a better future, such as schematics, brandings, or intellectual properties. For startups, most of their valuations happen to be based in those intangibles, which can be valued in more favorable market terms. What this really means is that there could be a huge difference between the market cap and the enterprise value, giving a false impression to the market participants that a company is trading at a discount. It's only trading below the book value, but doesn't mean that the company itself is necessarily undervalued. It's also possible that the company itself was overvalued in the first place and that it has only deflated back to where it should be. As we compare the current price to the historical price fluctuations, the stock is 1% higher than the 1-month low, 2% higher than the 3-month low, and 2% higher than the 52-week low. On the options market, which gives us a hint about the market sentiment of where the stock price is likely going to go next, the implied volatility is currently around 125%. The put-call volume ratio is around 0.48. It is normal for most stocks to have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 19,000 contracts a day versus the 30-day average of 25,000. Regarding the open interest, the most recent volume of open interest has been 222,000 contracts versus the 30-day average of 192,000 contracts. The option contract is a derivative from the underlying security, giving participants the possibility to have the right to either buy or sell the security at a predetermined strike price, buying the contract yielding the rights, and selling the contract giving you the premiums, with an obligation to execute the contract if the counterparty chooses to do so. It is often said that you can evaluate the likelihood of a scenario based on the opposite of what the current ratio is. If there's a lot of put options, there could be a possible uptrend on the move, or that a reversal could happen if there are a lot of call options. The reasoning behind the theory is quite simple, as most of the options contract expire worthless because people trading the contract options tend to try to catch a train that is long gone. Now, let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes, when there is significant short interest in the total volume, this could be a sign that there's an organized shorting operation going on, such as what happened with GameStop and AMC. The current short interest is 20% of the total float, and 43% of the transactions coming out of the dark pools. Usually, if the short interest is above 15% of the total volume and a significant portion of the short volume coming out of the dark pools, it may suggest that there are institutional positions taken to short the stock, and that there would be potentials for a short squeeze. My recommendation is therefore to buy Polestar now and to leave a significant portion of the allocation over the next 6 months to average out the potential volatilities. I would recommend to commit between 3 to 5% of your portfolio in Polestar, and would also recommend to split the allocation in batches of 20% at a time so that you can purchase more if it retraces. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.